VHYL and VWRL, two of Vanguard's most popular funds, but which is best? Let's find out. Just before we get into this video, you may have noticed that I'm wearing a pretty cool t-shirt, and I've got a new pretty cool mug as well that says Eat, Sleep, Invest, Repeat, with Invest and Repeat ticked because that's the most important. Not financial advice, not health advice. And the t-shirt also says Eat, Sleep, Invest, Repeat, with Invest in red. I'm a little bit obsessed. The mug is already for sale if you want it. It's in the description below. And the t-shirt may or may not be for sale at the time of this video coming out. If it is already on sale, it will be in the description as well. And if not, just let me know in the comments that you do want one of these and I'll get it on sale as soon as possible. Talking about the mug, you can get one of those for absolutely free if you become a VIP Patreon member, along with lots of other perks like exclusive access to the Discord community, member-only updates when I buy and sell, entered into a biannual giveaway, and also on the VIP one exclusively, you'll get a monthly one-to-one video call with me where we can chat all things investing. So if you want to look at different investing strategies, you want to talk about some stocks, anything like that's fine. But I will say it will not be financial advice. I'm not qualified to give financial advice. But anyway, I hope you'll check out the link to Patreon in the description below. But now onto the video. VWRL is Vanguard's FTSE All-World ETF with the inception date of the 22nd of May 2012. The index it's tracking is measuring the performance of large and mid-sized cap stocks of companies located all around the world. And the VHYL is Vanguard's FTSE All-World High Dividend Yield ETF, with the inception date 21st of May 2013. So it's about 1 year older than VWRL. The index that this one's tracking is comprised of mid and large cap stocks, excluding real estate trusts, in developed and emerging markets that pay dividends that are generally higher than average. Both of these are incredibly popular with investors, and for good reason. I'm a bit of a nerd, so I've put together a table just to run through some similarities and differences, and then we're going to do a little bit of a deep dive into each one. So just looking at this table that I made at a glance, you'll see that there are a lot of similarities between these two funds, but there are some key differences that you'll start to notice when you actually dive deeper into these. So let's just run through this really quickly. This is really important information that you need to know before investing into any of these funds. So the fees. As an investor, investing into a fund like VHYL or VWRL, or any of Vanguard's funds for that matter, you want the lowest fees as possible, because the lower fees you're paying, the more money you're getting to keep. However, these are both very, very low. Across the industry, these are very low. Vanguard's known for offering very low fees, so I'm not really surprised at all here. You'll see that VWRL is slightly lower at 0.22% than VHYL at 0.29%. But either way, both pretty low. Moving on to the type, they're both ETFs. Holdings, you'll see that the VWRL has a lot more holdings at 3,744 at time of filming this video, whereas VHYL 1,804. Still has quite a lot, but VHYL is primarily focused on those higher than average dividend companies, which naturally is more selective and will remove a lot of companies, whereas the VHRL, this is a tongue twister, these two, is getting a lot of the companies, like a lot of the market. So you're not excluding particular companies, hence why it's a lot larger. Cap sizes, they're both interested in the large and mid cap, so you're not going to get any exposure to those small cap companies that perhaps the FTSE All Cap that Vanguard offer would get you. Developed and emerging markets, this one's becoming quite increasingly popular for investors. As time goes on, people want more exposure to the emerging markets, as there's an argument that that is the new and upcoming market to be following, with lots and lots of growth potential. With either of these, you'll get an exposure to both developed and emerging. Next is the risk. Now, this one is a little bit subjective. This is what Vanguard has rated the fund out of 7. 7 being the most risky, 1 being the least. You'll see that they're both scoring quite high, 6 out of 7. Now, that is because Vanguard typically give any equity-based funds a larger risk rating. If they've got bonds involved or it's just a bond fund, you'll see that this is a lot lower, just because equity tends to be a little bit more risky than bonds. But to be honest, 6 out of 7 doesn't frighten me at all. Moving on to the dividend yield. This is where you start to see a difference in the VHYL particularly, because we know that that is now a high dividend ETF. So you would expect the dividend yield to be a lot higher, and it is. It comes in at 3.8%, whereas VWRL is just over 2%, which I actually still think is quite a nice amount. Dividend frequency, they're both quarterly payers. They will pay you 4 times a year, and you'll notice that they're paying out their payable months are exactly the same: March, June, September, and December, which I think is quite nicely spread throughout the year. So now let's actually do a little bit of a deeper dive. Vanguard's website is absolutely fantastic for looking at their funds. These are Vanguard offered funds, so you would hope to see that. But the first thing, VWRL. How much is it to buy 1 share of this fund? You can see here, as of the 6th of January, it costs £83.95 to buy 1 complete share. If we just jump over to VHYL, you can see that it's slightly cheaper. You can own 1 share of this one for £49.65 as of the 6th of January. You'll need to find out whether your brokerage allow fractional shares or you have to buy whole shares, because if you do have to buy whole shares and you're a beginner, you might not be able to afford the price of 1 whole share of some funds, whereas you might of a different fund. So just something to think about. Now, I think the most fundamental thing to look at between these 2 funds that we haven't already is how they're distributed in what they actually give you. So we've already mentioned the number of stocks, so I'm just going to go past that and we're going to look at the region exposure first. So with the VWRL, this is so hard to keep these acronyms up. You'll see it on the screen if I ever mess it up, and you'll know which one I'm speaking about. So with the All World, you're getting 62.9% exposure to North America, 15.9% Europe, and you can see the rest here. I'll point out that you are getting just over 10% to the emerging markets with this fund. So primarily you're getting exposure to North America, but that is expected given that the US economy is the biggest in the world. Let's compare that to the high dividend ETF. So you can see that actually it's split a little bit differently. You're getting a lower exposure to North America at just under 50%, but you're getting a higher exposure to Europe. And this, like I said, this is different because it's selecting the companies that are paying slightly higher on average dividend yields. What I will say actually, when you think about, oh, this is a high dividend ETF, you probably think that you're going to get loads of those companies that are luring investors in and have a really crazy high dividend yield. That's not the case. You are getting valuable and quality companies in this, which we'll see in a minute. But yeah, 24% Europe, and then higher than the other one, it's 11.2% emerging markets. And you're getting some Middle East and other here as well. Okay, back to All World. I actually really like the exposure, the region exposure and the holdings that this fund gives you. But for me personally, just being transparent here, I actually hold VUSA, which overlaps with this fund in its companies quite a lot. But if you're only investing in one fund, VWRL is an absolutely fantastic option. You know, you're getting exposure to a global market. It's so diversified. It actually covers more than 90% of the global investable market capitalization. That was a mouthful. So yeah, it's a really good one to have, and it's very popular, like I said, for good reason. So just scrolling down here, we can see exactly the market allocation. So it's not surprising that the largest is in the United States, and we're actually getting quite a lot in Japan, 6.1%, and then 4% UK, China, France, and so on. You can see that here, and you can check that out for yourself if you want to look into that a little bit more. Let's flip it over to the high dividend. You're getting 45.7 US, and then you're getting Japan at 7.5 and UK at 7.4. That's quite a high amount of UK, and then Switzerland as well, which could be surprising for some. And that's just because over here in the UK, we actually do have quite a lot of dividend paying stocks, quality stocks that feature in this fund. And lastly, what companies are you going to get if you purchase the All World? So let's scroll down and we'll take a look. Oh, just quickly, actually, sector. You can see here that VWRL has over 20% in technology, nearly 15% in financials, and the rest is listed here. And let's just compare that actually. It's quite different. The high dividend yield is 1/4, just over 1/4 in the financial sector. Then the healthcare, then consumer staples. We don't see technology until later on here, which is interesting. But the reason for that is quite clear. It's because technology companies, these big high-tech companies, tend not to pay a dividend. There's very, very few that pay a dividend, and then there's even fewer that pay a higher on average dividend. Whereas you see a lot of financial companies, healthcare companies, consumer staple, energy, so on. They're the ones that typically pay a dividend. And that is exactly why this sector is split like this. So there is some very, very strong differences between those two funds here in the sector area. So definitely look into that and decide what you want exposure to. Staying on the VHYL for now, let's look at some of the holdings. Like I said, these aren't just high dividend yielding companies, these are quality companies. Johnson & Johnson. No one can argue that Johnson & Johnson is a very, very powerful company. You've got, just to point out a few, you've got Procter & Gamble, you've got Nestle, which is of course a European dividend paying stock. You've got Pfizer, you can see for yourself, you've got some really, really big names. And the reason that I invest into this one is because of the exposure to some of these massive US dividend paying companies that I want. You can go on to the next page and you can see you've got Bank of America, Coca-Cola, Pepsi, Samsung, Shell, which is obviously a UK one, AstraZeneca. You will recognize a lot of these companies. Now let's look at the companies featured in the All World. Very, very different. You'll see that you're getting Apple, Microsoft, Amazon, you're getting Tesla. You don't see those companies in the VHYL, maybe Microsoft, but that's because an Apple. Actually, I don't think you get Apple because that's very low paying dividend. Anyway, the point is that a lot of these companies don't feature in the VHYL, and that's because they don't pay dividends. And they definitely don't pay higher on average dividends if they do pay. A little bit of crossover, Johnson & Johnson, you saw that in the VHYL. But like I said, I do think this is a great one. I just don't have it because it crosses over a lot with my VUSA holding. So with all that said, now let's take a look at their performances. VHYL has been up over the last 1 month, up over the last 6, and up over the last 1 year. 5 years it's up, and then if we max it out, you can see here. What I do want to point out actually, let me go to the All World. We're seeing a very different picture of the All World recently. You can see that over the last 1 year, the high dividend yield ETF was up, but the All World VWRL was down. Now that is not to say that that tells you everything there is to know about these two funds, because that's not the case. The reason that I think this is happening is because you're getting exposure to a lot of those big tech companies in the All World, the Apple, the Microsoft, the Tesla, the Amazon that we saw. And those companies are the ones that are plummeting right now, and that's going to be reflected in the fund. Whereas in the high dividend yield, the VHYL, you're getting those more stable companies, the ones that are not very cyclical. You know, your Johnson & Johnson, that they're stable, they're boring, but they tend to do quite well in a bear market, whereas tech companies tend to get hit harder. And I think that's the difference, but you know, you can see how powerful this is if you just max it out. Absolutely incredible fund. It's had some really, really great returns as well. I'm really sorry if you guys can hear a bit of background revving noise. Someone has decided that they must rev their car continuously. So let's just move on. I hope that stops and it doesn't impact this video. What I wanted to say is that obviously, past performance doesn't indicate future performance. You could argue that if there's a crash, then VHYL will outperform VWRL just because of its holdings. And you could argue as well that it has more essential companies, or that VWRL will continue just to do better because it's more diversified. So there is really arguments for both sides, and you'll need to see what works for you. I've pointed this out before, but it's worth saying again. You can actually get VHYL as an accumulation fund rather than an income fund, but for some reason, Vanguard don't offer it. I think like other platforms, Hargreaves Lansdown, whatever, I think they do, and I think it's called VHYG. So have a look at that if you're interested as well. I don't know why it's not offered on Vanguard when it's a Vanguard fund. Personally, I just have this one, so I've not really looked into it too much. VWRL is essentially the market, whereas VHYL is a subset of the market based on particular selection criteria. I wanted just to show you how much 100 shares currently of each one would cost and how much you would get in dividend payments. And the reason is because lots of my audience like dividend investing like I do, so it's interesting. But of course, if you don't care about dividends, then you don't really need to take this into account. So 100 shares of VHYL is worth it would cost you about £4,922, like I said, as of when I'm recording this video. And from that, you would get 4 payments a year, like I said, and based on the 2022 payments, you would get a payment of £26.83, £75.12, 45.33 and 34.34. Of course, if they increase their dividend yield as time goes on, these numbers will change. Moving on to VWRL, 100 shares would cost £8,355 because, like we said, one share of VWRL is more expensive than one share of VHYL. And the dividend payments would come out at 69.2, 45.50 and 31.49. So we're looking at similar dividend amounts, but it would cost you a lot more to produce those dividend amounts using VWRL just because of the share price difference. For full transparency for this video, I personally invest into VHYL and not VWRL, but that's only because I already have exposure with my VUSA fund to those big FANG US tech companies. But just from my research, VWRL does seem like a fantastic option. It's like a one fund hit to a globally diversified investment. Let me know your thoughts below.